So I'm really happy to welcome you to Oxford for the summer conference on this fantastic summer day. Maybe some of you are regretting now that you didn't make plans to go to the park instead of being here. But we will try to make it worth your while with, so we've picked what I think is a really interesting set of topics for discussion. And we have an amazing lineup of speakers. So I think it's gonna be even better than the park today, right here. So my name is Niels Johannesen. I am the new director of the Center for Business Taxation here in Oxford. I've taken over after Mike Deverer, who's been standing here many years. Mike is still around and still very active at the center. The plan for today is so many things are happening in tax policy. So the plan for today is to take stock a little bit of where we are and where we're going. We'll start until lunch. We'll talk about international issues, and then after lunch, we'll talk about more domestic UK issues. In the first session, we're going to talk about the pillars, a long-standing favorite here at the center. And then, in the second panel, we're going to talk about all the tax developments at the UN. After lunch, we will turn to UK transfer pricing policy in the third session, and then finally we're going to talk about a roadmap for business taxation in the UK, especially in light of the upcoming elections. So in the first, let me talk about the first session here is on Pillar 1 and Pillar 2. So the idea is really to talk about where we are, where we are going, what are the accomplishments, what are the challenges. What is already working, what is not working. We have a distinguished set of speakers. So the first speaker is Manal, who is Director for Tax Policy and Tax Administration at the OECD. We have Grant Wardell Johnson, who is Global Tax Policy Leader at KPMG. We have Marlene Parker, who is Deputy Commissioner General of the Tax Administration in Jamaica. And we have Paul Oosterhuis, who is a lawyer at Skadden, Arps, and a lecturer at Columbia University. So we have a good representation here of both policy makers and people who are in industry or talking a lot to people in industry. So a lot of different and interesting perspectives. Manal is the first speaker, so please. Yes. Okay. I'll try to enforce time a little bit strictly, just because we can easily get carried away and spend too much time on this. So I'll do my best sharing this.
Great, thank you so much, and good morning, everyone. It's a real pleasure to be here. It's my first time in Oxford. It's quite beautiful. I understand the weather looks like this all the time, so you're very, very fortunate. It is really a pleasure to be here to share some thoughts about where we are, but international developments at the OECD and opportunities going forward. I know, Niels, you said it was the pillars. I always want to begin with a bit of context, because it's important to think about the context in which the pillars have emerged. And so I'll start with some observations about that context and some more recent developments and where we're going a little bit at the end as well. So in terms of context, I think over the last almost 2 decades now, I would say, as a result of initiatives at the OECD, as well as the very, very constructive and committed engagement by the now 147 members of the Inclusive Framework on base erosion and profit shifting, and the now 171 members of the OECD Global Forum on Transparency and Exchange of Information, we have seen really an acceleration in the pace and the scale of multilateral cooperation on tax matters, leading to significant reforms that I have completely reshaped and continue to reshape the international tax landscape, and have produced concrete outcomes and results. Effective collaboration on the OECD platform has led to the end of bank secrecy, the introduction of new and reinforcing new standards, but also reinforcing existing anti-abuse measures to deal with tax avoidance, tax evasion, and other illicit financial flows, and the establishment of new global standards for VAT guidelines, and most recently the establishment of the global minimum tax that sets a floor for taxation to neutralize economic distortions, increase tax revenues, and reduce opportunities for tax avoidance. So I think a defining feature of the multilateral cooperation over this period has been the increased focus on inclusivity. And so if we just take a snapshot of that, for example, since its launch in 2016, the inclusive framework has grown from 82 members to now 147 members, with the recent addition of Kuwait, Fiji, and Moldova, with interest in joining remaining strong. And we're continuing to talk about jurisdictions who are interested in joining the conversation and the framework. Similarly, the Global Forum on Transparency, as I mentioned earlier, on transparency and exchange of information has now grown to 171 members, and we are also seeing growing adoption of or participation in various OECD instruments and standards. So I think to understand the journey so far and also then to reflect on the road ahead, I think it's important to recall and reflect on the fact that the right to tax is really fundamental to sovereignty, and it's a very, very guarded, well-guarded fundamental aspect of sovereignty, because I think sometimes that gets lost in the conversations about global cooperation. So countries that are involved or are motivated to collaborate, involved in international coordination on tax matters, do so when they're motivated to do so when there is a belief that collective action or coordinated action globally is necessary to secure or facilitate their sovereign domestic policy objectives. And that is very, very important, because that is the motivation. So it's where collective action is necessary to protect sovereign or domestic interests that are otherwise rights that countries have today and continue to have. So to this end, I think the common areas of convergence that we see for cooperation include closing information gaps that facilitate enforcement. So transparency is an important area where collective action supports domestic interests and ensures fairness. Coordinating on international rules and standards to remove barriers to cross-border growth and investment, so coordination to avoid multiple incidents of taxation that may inhibit investment or inhibit the ability to attract investment into domestic capitals, or cooperation to protect tax bases, where the opportunities to arbitrage across jurisdictions risks eroding the base and the domestic interests you have. And then coordinating certainly on tax administration, both to foster certainty as well as to support domestic resource mobilization. So, and to coordinate on development efforts. So as a platform for collaboration, these areas of convergence and collective interest have really informed a lot of the work that has been covered by the OECD. It includes work on standard setting, certainly, but it also includes work on tax administration, tax certainty, tax transparency, tax and crime, and to address illicit financial flows and many other areas. So I think with this backdrop, what I want to do is focus in on the two areas in which we've seen the most transformational changes emerging from the increasing inclusivity of global tax cooperation over the last decade. So transparency and the BEPS initiative, leading to now the focus on the two pillars. Tax transparency is, I'm going to get to the BEPS project in a minute, so maybe we'll stay on this slide. So tax transparency is really a stalwart of multilateral efforts to coordinate on tax, really, really critical. The efforts were accelerated in 2009 when the G20 finance ministers endorsed a crackdown on bank secrecy, and the establishment of the OECD-hosted Global Forum on Transparency and Exchange of Information for Tax Purposes was reinforced. The Global Forum had previously existed. It really accelerated in 2009 in the wake of the banking crisis and concerns about secrecy. The Global Forum has led the way in implementing tax transparency standards on exchange of information, on request and automatic exchange of information with significant effect. The work has been a game changer, effectively ending bank secrecy and unlocking over 130 billion of additional revenues, of which around 41 billion euro has been identified in developing countries. The second area where we've seen strong gains from inclusive multilateral cooperation on tax is, of course, the BEPS project. And if we look at the original BEPS project, which was driven by a recognition among governments that international rules and standards needed to be modernized and adapted to the rapid digitalization and globalization of the economy. It was finalized in 2015, and it was launched originally by the starting point for it was diagnosing where there were vulnerabilities in the existing systems, the existing rules that enabled base erosion and profit shifting, and then agreeing sort of 15 actions to address those vulnerabilities. They, among of the 15 actions, 4 minimum standards emerged that were viewed as fundamental, where you could get consensus on implementing as important tools to stem the tide of base erosion and profit shifting. Those actions were the first dealing with harmful tax practices, Action 5, which addresses through peer review and exchange of information concerns about practices that were undermining tax bases. And so to talk about impact of these, over 54,000 exchanges of rulings have taken place among 130 jurisdictions based on our most recent data. Under Action 6, the BEPS multilateral instrument to address treaty abuse, the use of treaties in ways that were not the intended outcome, has been signed by over 102 jurisdictions, covering 90% of tax treaties concluded between inclusive framework members. With respect to Action 13, dealing with country-by-country reporting, 115 jurisdictions have introduced country-by-country legislation, and more than 3,400 bilateral relationships have been established for the automatic exchange of information on cross-border operations of multinationals. And then finally, with respect to Action 14, which was looking at the way governments engaged in dispute resolution through the MAP processes, taxpayers are increasingly increasing their faith in MAP owing to the greater availability of MAP and access resulting from the peer review. And we now have MAP statistics, importantly, on 133 jurisdictions, which covers practically all MAP cases worldwide. So turning to, with respect to developing countries, because it's a very important part of the story here, developing countries have been participants in and beneficiaries of the BEPS standards. For example, 45 out of the 90 countries implementing the interest limitation rules under Action 4 are developing countries. With respect to Action 5, 48 developing country members of the inclusive framework have received information on tax rulings that can be used to address enforcement in their jurisdictions. 42 out of the 102 signatories of the multilateral instrument are developing countries, and 37 out of 67 MLI signatories who have adopted the higher PE standard under Action 7 are developing countries. And finally, developing countries are participating in Action 14 in terms of MAP review and benefiting also from deferred and simplified peer reviews to adapt to their circumstances. With respect to country-by-country reporting and developing countries, we absolutely recognize that there needs to be additional support and work to further enable increasing the amount of country-by-country reports received by developing countries. Right now, there are 24 developing countries that have C/CR in place, and we are with partners, development partners, redoubling efforts to enable increasing the access for developing countries, including not only through bilateral support, but through support with IT solutions, support through how to use the information for risk assessment, as well as through our Tax Inspectors Without Borders program. And then looking at the architecture and requirements to make sure that there aren't things that are standing in the way that are inconsistent or aren't necessary for the policy. There's a lot more to be done here. We absolutely acknowledge that, and it is an area of our focus. We've recently published a 15-year retrospective on the tax and development work at the OECD, and we continue to really put our energy towards ensuring that not only we're providing the support on all aspects of the work that we're doing, but ensuring that we're addressing concerns about fully inclusive participation by developing countries in the processes of the OECD. So one of the areas that we're quite proud of and is a program that has been growing and continues to grow is our partnership with UNDP on Tax Inspectors Without Borders, as well as with other international and regional organizations to provide, as I said, extensive and increasing range of technical support for developing countries to boost domestic resources and also realize the benefits of some of the changes in the international system. Turning to assessing behavior, so in addition to measuring uptake, and I've been talking, and some of the data I was providing is uptake of standards and measures, it is important to also measure impact. And that can be more challenging because the implementation of BEPS measures is still in its early stages. So for example, the first exchanges of country-by-country information took place in June of 2018. And similarly, for all but a handful of jurisdictions, the multilateral instrument to tighten the treaty abuse did not enter into force until after 2019, and for the vast majority of the 102 signatories, it entered into force after 2020. So given the lag in empirical analysis, many studies either predate implementation or are based on very early days of available data. Nevertheless, I think there is both anecdotal and empirical evidence beginning to emerge on the impacts of these BEPS measures. The latest C/C data shows in 2021 a significant reduction in profit accumulating in investment hubs relative to 2018. There's evidence that the introduction of interest limitation rules has resulted in reductions in debt financing that reduces tax bases in affiliate source countries, and we know that firms that are subject to C/C are reporting higher taxes globally and reducing their presence in very, very low tax jurisdictions. So again, that is the foundational, the context in which there emerged the work on the two pillars, but the work that led to it is ongoing, and we are focused on making sure that we're measuring impact and maximizing effectiveness, including among developing countries. So turning now to the two-pillar solution, the work of the Inclusive Framework to implement BEPS actions also led to the agreement of October 21 on the two-pillar solution to address tax challenges of the digitalization of the economy. And here again, consensus-based coordination has generated tangible results. So starting with the status of the GLOBE rules, so Pillar 2 had two components, the global minimum tax as well as the subject to tax rule. So the global minimum tax has now gone into effect as of January 1, 2024, with around 36 jurisdictions implementing with effect in 2024, and over 20 jurisdictions planning to implement in 2025 or later. And based on what we know of countries who have immediate plans to implement the minimum tax, we're estimating that roughly 60% of jurisdictions that are in scope, multinationals that are in scope, will be subject to the minimum tax regime in 2024, and with that number growing to roughly 90% in 2025, based on data that we have today. If you look at the geographic distribution of implementation, so just a snapshot of where we're seeing early implementation, you can see the majority of countries implementing are in Europe because of the EU directive. But what is not yet apparent from this distribution and the numbers that are being reported, but will become so shortly in the coming months, is the number of countries that are currently in the process of drafting legislation for a domestic minimum top-up tax. And we are actively in conversation with those countries as their legislation is being drafted and reviewed and being put in place, and we expect many of those will come online likely in 2025. So, but have not yet announced plans. It's important with respect to these rules now that they are out there and are in their implementation phase to focus on ensuring consistency and certainty. And there are a number of mechanisms for achieving this in the context of the rules. First, reliance by implementing jurisdictions on model rules and commentary, including an agreed rule order and embedded simplifications, ensures that there's a common starting point for the rules. Second, the issuance of administrative guidance and the reliance to some extent, as appropriate, on safe harbors, such as the CBCR safe harbor, supports the transition from adoption to implementation. And then finally, the establishment of a process for determining the qualified status of implementing legislation, followed by ongoing monitoring, as well as a potential MLC that we are members are discussing right now to facilitate dispute resolution. All of these are mechanisms intended to reinforce consistency and offer long-term certainty and stability of the rules. With respect to administrative guidance, we just released new sets of guidance earlier this week, which responds to stakeholder requests for simplification or clarification of rules, with a particular focus on clarifying mechanisms of calculating the ETR base on our jurisdictional basis, as well as simplifications in the rules for crediting deferred taxes. We also will have a Q&A on the approach to qualified status and the process for getting qualification for domestic top-up taxes. We understand we need to strike a balance between administrative guidance, which many stakeholders ask for clarifications, and then other stakeholders are concerned about the extent to which it undermines laws that already have existed or requires additional changes, and that is a balance that needs to be struck. And as we move from the implementation phase or out of adoption and into implementation, increased reliance on enforcement, tax administration, and peer review will be the preferred mechanism of interpretation. The second component of Pillar 2, the subject to tax rule, very, very critical. It was recognized in the original October 2021 agreement, the 2021 statement, as an integral part of achieving consensus on Pillar 2 for developing countries. It enables developing countries to tax intra-group payments that are subject to low nominal rates, so rates below 9% in a treaty partner jurisdiction, and a multilateral instrument and explanatory statement implementing it to facilitate implementation was adopted in September of last year and opened for signature in October, and a signing ceremony for that instrument is now planned for the 19th of September. We're expecting at least 30 to 40 jurisdictions, both developed and developing countries, to participate. And we are now having confirmations to participate in the formal signing ceremony. So turning to Pillar 1, which continues to progress. Again, two parts here to Pillar 1. Amount A, internationally agreed reallocation of taxing right to market jurisdictions. It doesn't grant a right to tax to market jurisdictions, so going back to the context I set out, every country is sovereign and has the right to tax how it wishes to do so. The coordinated allocation of taxing rights creates cover where acting alone may be frustrated. And this is a transformational approach to taxing, to a coordinated approach to taxing that recognizes an increased allocation to the market. It also, Pillar 1 also includes Amount B, which is a simplified transfer pricing approach for baseline distribution activity. So we published a text of the MLC implementing Amount A last year and updated the timeline in December. We had a full inclusive framework meeting at the last week of May and made sufficient progress on what were the areas of where there were gaps in agreement. So made sufficient progress to close those gaps to allow the co-chairs of the inclusive framework to issue a co-chair statement. We've got one of our co-chairs here with us, Marlene. And the co-chair statement not only summarized what was a very productive 3 days of meetings that covered many topics, but also provided an update on the fact that we are nearing completion of the negotiations on the final package. And it is a package of both Amount A and Phase 2 of Amount B, but also recognized and welcomed the expressions of interest from both France and Brazil to host a signing ceremony as soon as practical after the MLC is adopted. Turning quickly to Amount B, Phase 1, on February 19th, the Inclusive Framework published the final report for Phase 1 of Amount B. The content from that report has now been incorporated into OECD transfer pricing guidelines. And then in the 4 months since the publication of the report, the Amount B report, we have observed a significant number of countries indicating their intention to implement Amount B. Several countries have reported that roughly 30 to 70% of their transfer pricing disputes relate to baseline marketing and distribution activities. So particularly with countries where there aren't comparables and low capacity jurisdictions, this is very, very welcome adoption, and it was important to get the Phase 1 components out there. The African Tax Administration has described these changes as vital, providing what could be a game changer for the African transfer pricing landscape, and I'm quoting. So the focus is now to expand that framework for the application of Amount B, recognizing an interdependence between Amount A and Amount B, and to broaden its application to offer certainty and stability where there is baseline distribution activities on a reliable basis, broader than just circumstances where there are low capacity jurisdictions or comparables. And that work is part of the remaining pieces of the puzzle that get us across the line on the Pillar 1 package. So looking ahead, to the future, I think we recognize, and I think many of international organizations recognize, that existing forms of financing make up only roughly half of the revenues that are going to be needed to finance the Sustainable Development Goals. So the financing gap remains huge at roughly $4 trillion US. Taxes do represent the largest and most stable source of revenues for development. And the work on BEPS has been an important part of shoring up our corporate tax systems and preventing their erosion over time and hopefully contributing to that. But given the scale of financing required, increasing revenues from other sources, including other types of taxes, is absolutely going to be needed to meet the needs, and continued focus on collaboration and development is also going to be critical to unlock domestic resources. So we know inclusive, collaborative, and complementary international cooperation is going to be more important than ever across international organizations and regional organizations. So in this regard, we are looking forward to continuing to build on and glean lessons from the achievements to date to further the collective efforts to achieve a fair and inclusive tax system. So with that, I will close and turn it back over to you. Thank you.
So we could take a few questions from the floor at this point, like if you're up for it. Sure. Does anyone have someone they want to ask Manal? Yeah.
Hi there, in-house tax advisor. Just interested on CVCR and where it started, and obviously it's got lots of other uses now, right? So it started as a risk assessment tool, master file, local file, CVCR. And I think you still talk about it as a risk assessment tool. A couple of questions. do you see lots of tax authorities using it as a risk assessment tool in practice? And then my second question is, do you have concern around what it's being used for now? So I think maybe less so on safe harbour, but in terms of external publication, do you think it's still fit for purpose in terms of what it looks like as a template?
So I think the goals of CBCR were intended to create a tool that allowed countries to see the big picture, because there were circumstances where the narrative that might have emerged in one jurisdiction and supported the assessment of tax didn't match up with the narrative in another, and because of the pieces of the puzzle, it was important to assess the risk of the need to look further to have the full picture, and it served that goal, is to provide a sufficient picture across all of the operations in a way that a country can make a decision as to whether or not it needs to look further. So a risk assessment tool, and that continues to be the role. It wasn't intended to replace domestic policy decisions about how to further add enforcement or abuse measures or concerns, or to have reporting that is suitable for the jurisdiction. I think that the concerns about the use of CBCR reports in a manner that was inconsistent with the agreed, the agreement, the global agreement, is something that is the subject of peer review, as well as will be the topic of an upcoming, there was built into the CBCR a review. We've I think there was a deliberate decision to give them a little bit more time before that review is happening, and then to the extent that will be used as a base. I mean, there's a safe harbor component that's being used in the GLOBE rules, to the extent that there will be a simplification where you'll have a singular reporting that could support both. It may change the character of it, but all of that needs to be reflected on very deliberately and carefully to ensure that it's fair, balanced, but serves the purpose for tax enforcement that it needs to serve.
Do one more question. There's one up here.
Hi, thank you for a very interesting presentation. You talked near the end there about the way that amounts in Pillar 1, Amount A and Amount B are part of a package. Do we take that to mean that a mandatory adoption of Amount B beyond low capacity jurisdictions is a necessary precondition for getting the Amount A multilateral convention signed? Is that the case?
Yeah, so there's an Amount B framework that is going to go beyond the B that is out there already, and that I think has been, we're not going to talk specifically about what's going on in the negotiations, because that's not it's not constructive to getting to the finish line. But I will say that an Amount B framework that is reliable and so can be counted on is part of an important part of the overall package. The Pillar 1 is ultimately about stability and certainty. It's two value propositions. One is to do a transformational change, a multilateral or multilaterally recognized reallocation of taxing rights to markets, so an increased allocation to markets that's coordinated and agreed. That's an important value proposition and is foundational. And then the second is to stabilize the international tax system, one by trying to stem the tide of unilateral measures that undermine international agreements that have lent to stability, but the other is through certainty for dispute resolution, and including recognizing that disputes regarding routine transactions are not productive for either taxpayers or for government. So it is very much part of the package, and it needs to be a reliable framework, and that's what we're discussing.
All right. Thank you very much, Manal. I suggest we move on now with the next three speakers. So first Grant, and then Marlene, and then Paul. You have around 15 minutes each.
Thank you very much, and thank you for inviting me here. So I'm Grant Wardell Johnson, and I'm KPMG Global Tax Policy Leader, and the comments I'm going to make my personal views are not sort of official KPMG views, and what I'm going to do is make 10 observations in the 15 minutes that I have. So observation number one, and these are focused on compliance, and I will focus on pillar 2 in relation to the Globe rules. So my first observation is that the purpose of the Globe rules is to change behaviour and not to raise revenue. Indeed, in the OECD statistics, of the 200 plus million they expect to raise, about 2/3 of that is actually raised in top-up tax and 1/3 in changed behaviour. And what it does mean is that the cost of compliance per revenue raise is probably not a good metric in relation to Pillar 2. Things do work on a rhetorical dimension. So to misquote Jane Austen in terms of her Sense and Sensibility, whilst most of the people in this room would think that through a sense framework, there is a sensibility framework through which many people in civil society, the media, and indeed some elements of business think it through. The second observation I'm going to make is in relation to the fact that Globe is a new tax, and you would expect with a new tax a higher compliance cost initially and then for it to lower over time. And that is actually nuanced in this case because you have transitional safe harbours that lower the cost of the obligations associated with the tax in the earlier years, and then you have the full rules coming in after that time. That in itself is nuanced by the fact that we don't have permanent safe harbours. So you have businesses trying to work through what they need to do. They've got a simple framework in terms of transitional safe harbours. They don't know what the permanent safe harbours are going to be like in the future, but they do know that where you fail the transitional safe harbour, or indeed the permanent safe harbour of the future, you're going to have to apply the full rules, and so you're going to have systems in relation to those full rules. Unintended consequences is a function of any tax, and they will come to the fore in due course, and they're coming to the fore now, but they have a tax cost in relation to that. If you look at the cost in relation to multinationals, it's very varied. The profile in relation to how Pillar 2 works for multinationals is very varied. The third observation I'd like to make is that Globe is an evolving tax. It's one of those where you're building it while flying. And indeed, the model rules came out, as you would know, in December 2021. We had commentary in the following March, and then 4 tranches of administrative guidance, the last one being released on Monday. And with the Globe Information Return rules, you've got about 1,000 pages of documentation in relation to that. Now, the commentary and the model rules don't always coalesce. You can't politically go back and change the model rules in a way that you can change domestic legislation. So that's something quite structural in relation to that, and something that just should be recognised. The fourth observation I'd like to make is that the Globe is politically negotiated, and so the perfect can't be seen as an enemy of the good. There are political compromises in relation to that, and one of those that is in some sense difficult for business is the flexibility in relation to the qualifying domestic minimum top-up tax. So local jurisdictions have been given a degree of flexibility in terms of using local accounting standards, which adds to compliance costs in relation to that. But I think that was a political necessity in terms of the negotiation process. If you look at the structure of the tax, it works on buckets and blending in terms of joint ventures or co-ownership, etc. There is not always a match between the economics and the tax. And at the edges, that can cause difficulties and negotiations between various joint venture parties. That is structural. If you're going to have a simple part of co-ownership and rules in relation to that, you will inevitably end up with that element. And so it's something which is deliberate but has odd consequences in particular circumstances. The main policeman in relation to Pillar 2 is what they call the UTPR, which I'm sure is familiar to most of you in this room. That is not entirely popular, and certainly not popular in parts of the US. But I think it's necessary, and it's something that the OECD Secretariat, or together with the Inclusive Framework members, could not give up. It's needed in order for the system to survive. It adds significant complexity, but it's an essential part of the framework. What it does, I think, for some people that don't know, is it acts as a policeman in the sense that sister companies, rather than the local company or further up the chain, can provide or can levy top-up. If a jurisdiction adopts the UTPR, then that sister company can have top-up tax imposed for a company elsewhere in the group. My fifth observation is that accounting is the foundation of the Globe rules, and that has been a very major achievement. I think it's a very good, but it's not without its difficulties. In some sense, the composition of the tax is a function of three mindsets: tax professionals, accounting professionals, and those in M&Es that have business systems in relation to that. Now, those three mindsets don't always coalesce, and some dominate over others in particular circumstances. There was a political need to have accounting standards, allow accounting standards, a whole variety of accounting standards throughout the world, and there are safety mechanisms in relation to that, but that creates complexity. And there is a need to ensure that the IFRS accounting and US GAAP accounting are on the same playing field, and one's not disadvantaged by the other. And given the fact that IFRS basically has fair value transfer rules, and US GAAP has cost transfer rules in particular circumstances, the complexity of the rules has been enhanced in relation to that. One of the difficult areas in relation to the Globe rules is deferred tax accounting. So the Secretariat and the Inclusive Framework members accepted businesses' desire to have deferred tax accounting as the basis for timing rules in relation to that. That has its pros and cons. One of the difficulties, I think, in relation to that is it's a black box to many, and I think it would be difficult for many developing countries. One of the benefits is that in many situations it fits very comfortably with business systems. There's complexity in relation to that, and in the Administrative Guidance number 4 that was released on Monday, you can see that complexity, and there's a whole chapter on it in sort of 30 or 40 pages on rules in relation to what they call DTL recapture rules. So deferred tax accounting has created its own complexity. Whether in hindsight you'd actually go down that route, and has some degrees of alienation in relation to that, but it generally fits with business systems. Accounting as a whole has been a fundamentally good thing in relation to these rules. The sixth observation I'd like to make is that there are drivers, significant drivers to divergence. So the QDMTT variations throughout the world will be important. The different counting standards applying will be important. But there are divergences from jurisdictions. If you take Belgium, so Belgium's going to use the Globe rules to present an advanced payment system, and they're requiring registration for those entities with any Belgian entity in their structure to register by the 11th of July. That's different for late balancing companies, but and to provide details of their whole structure in relation to that. So that's out of step with the other jurisdictions implementing, but you'll get that in multiple times. On the internal rules, it's really interesting issues that I suppose the drafters place. There's a concept of ownership interest, which is actually quite critical to the rules. There are 18 uses of that, but there's not a consistent use of the concept of ownership interest throughout the rules. In fact, there's commentary in relation to that say there are 3 categories: 1 where it's specified, 2 where there's a natural metric. A natural metric might be if you've got a partnership, equity becomes the natural metric in relation to ownership interest. And the third is a faux demure, sort of a default when nothing else seems to work, which has equal weightings between various categories. There's complexity that arises from that. Whether that was desirable or not, in not spelling out all the ownership interest operations and filling out the rules to a great extent, is a really interesting question. And often the OECD has chosen to spell out those rules. And the other thing will give rise to divergence is revenue authority interpretations, and they will be quite varied. I should let you know that the term entity in the model rules is specifically defined and picked up by the EU jurisdictions, but it has been varied by the UK. Canada's followed the UK, as has Singapore, and Australia's gone for the model rules, but the commentary is actually the same as the UK. So that trusts are intrinsically in the UK model rules, whether there are financial statements prepared or not. So there's variations in relation to that interpretation. My seventh observation is that the model rules attempted to rely on existing delineations, but not fully. You see that in international shipping, where they couldn't pick up the tonnage tax rules or even Article 8 of the model treaty. You see it in the asset management rules and the definition of investment funds, where they've tried to outline 7 indicia, but they doesn't necessarily fit with how practice operates. My eighth point is that there's a cultural drive to greater certainty, and that comes at a cost. You see that in Pillar 1 big time, insofar as I think the OECD itself said these rules could be done in a very short space, but we've actually gone to deep thinking to try and solve as many problems as we can. So rather than 50 pages, you've got 800 pages in relation to that. We, as a profession, have a drive to that level of detail. In terms of Amount B, which Manal mentioned, I suppose the original conception of that was, let's have a 3% across the board. Now what you do have is you have a table, depends on industries, depends on your expense rate, certain expense and asset ratios, etc. So it's complicated by that, and there is a drive to that detail. We don't, as a profession, do swings and roundabouts very well. My ninth point is M&Es will use technology in relation to this in terms of evaluating. Initially, they're likely to use Excel spreadsheets, but that will actually move to significant software in order to actually make the calculations and provide the descriptions that are needed in the GIR return. And my final point or observation are what are the top 5 things that CTOs will think about in relation to this domain. And for many, the compliance burden is significant in relation to the impact. So you'll see a CTO saying, okay, we've got 100 odd companies in our group. The rules only kick in relation to 5 of them. That is a common phenomenon in relation to that. The second one is incentives and the way in which incentives have operated. One of the things about the rules is people didn't understand, if you like, the full rules initially, but it evolved over time. That was particularly the case in the US, and how it became a realisation that incentives had a big impact in respect of this. The OECD itself has said that 53% of M&Es with sub 15% profits below the threshold are in high tax jurisdictions. That is a very, very surprising statistic when you thought, okay, well, the global minimum tax is geared at tax havens, etc. There's a land between consolidated financial accounts and local accounts which creates its own complexity. For instance, just a quick instance, you might have a multinational group that creates IFRS accounting for its external transactions, but just simple accounting for its internal transactions. They will now have to revisit that to cover the internal transactions under IFRS accounting. There's fear of the use of information in the GIR return and how that will be spread. And then finally, the QD-MTT variations is a big concern to CTOs. So this is one of the major changes that we've had in the last 8 decades It has elements of complexity to it which are inevitable, but overall I think it's been a worthwhile exercise in pursuing globally. Thanks very much.
So the next speaker is Marlene Parker. Please, Marlene.
Good morning. Just want to say thanks to Said for inviting me to sit on this distinguished panel. I have been here for a week and I have been enjoying Oxford. I had the privilege of being with the law school at the courtesy of Professor Cicely Dagan and her outstanding students, and it was great. So Manal focused quite a bit. She gave you a broad overview on the two-pillar solution, and so I'm going to confine my remarks to just some of the concerns as well as the benefits that developing countries perceive will come from Pillar 2. And it's not that we don't have some concerns about Pillar 1. Those concerns are mainly, however, around the length of time that it is taking to sign the MLC, right? Which we hopefully, we're getting closer to that time. However, where we do see the opportunities are in Pillar 2. And that is in relation to the QDMTT rather than the globe rules. So I'm going to start out by looking at the general perception by developing countries, and then I'm going to speak a bit about the concerns at ATAF, which has been very involved, as well as along with other African countries in the negotiations, and to look at their perspectives and their recommendations. I'll speak a little bit about my own country's attempts to introduce the QDMTT and where we are now, some recommendations, and then I will end briefly by making a brief statement on the STTR. So many developing countries do not consider that they will collect significant tax from the IIR, as they do not have ultimate parent companies in most cases, with global revenue of more than 750 million located in their jurisdictions. They also consider that they will not collect any significant tax from the UTPR, as the global rules are designed as such that the UTPR is only a backstop to the IIR, and so will only apply in exceptional circumstances. Its application is further restricted by the recently agreed UTPR transitional safe harbor that applies until the end of 2026, whereby the UTPR will not apply to low tax profits in jurisdictions with a statutory CIT rate of 20% or more. However, many developing countries have granted tax incentives which result in an effective tax rate of less than 15% to some multinationals. Under the globe rules, where a tax incentive results in an effective tax rate of less than 15%, the globe rules will lead to another tax jurisdiction, usually the jurisdiction where the multinational is headquartered, collecting the difference between the effective tax under the tax incentive and the minimum effective tax rate of 15%, the top-of tax. When I come to speak about Jamaica, I will say a bit more about our own challenges in relation to the having to introduce the DMTT quickly. So many developing countries consider the domestic minimum tax as very important because it offers revenue opportunities as it allows the country where the low tax profits arise from the tax incentive to collect that top-up tax rather than allowing it to be collected by the headquarter jurisdiction. So far, over 50 countries have announced that they will enact the global rules in 2024, and many will start collecting top-up tax in this year. Therefore, developing countries have started to consider carefully whether to act quickly and enact the qualified domestic minimum tax to protect themselves from giving away taxing rights to developed countries on top-up tax arising from their own tax incentives. Up to 2023, the OECD's impact assessment estimated that the globe rules, including the QDMTTs, will raise additional taxes of over US $200 billion each year, and that approximately 53% of global low tax profits of large MNEs arise in normal rate jurisdictions and not in low tax jurisdictions. So the tax revenue opportunities, therefore, are very material, particularly to domestic resource mobilization. And developing countries need to move quickly to collect the tax through the QDMTT rather than allowing another jurisdiction to collect it via the IIR. ATAF has recognized the importance of this rule in Africa, and they have gone ahead and they have published a revised ATAF approach to drafting what they are referring to as the DMTT. Their concern there is that the rules are a bit lengthy and complicated, and so it is very likely that the approach that they will use is that they will have in primary legislation just some very basic provisions and then use by reference the QDMTT rules, which is what New Zealand has used and what Jamaica is also planning to adopt. However, ATAF and others have noted that implementing DMTT is not the only way to respond to the introduction of the global rules. Developing countries should all consider wider corporate income tax reforms to ensure that MNEs operating in their country are paying tax equivalent to at least an effective rate of 15%. Increasing the statutory corporate rate tax is unlikely to do that, given that statutory tax rates are already high in most developing countries. Developing countries should also consider a broader reform of tax incentives that result in effective tax rates below 15%, including introducing other taxes, such as an alternative minimum tax. Reform of excessive tax incentives and very careful reflection before introducing new ones is needed, and the introduction of a DMTT tax only gives more impetus to undertaking this critical work, as developing countries can move swiftly, collectively, and more confidently in making changes. However, these tax considerations require careful reflection to balance the need to ensure that revenue is not left on the table. And so at this point, I will speak about Jamaica's own efforts to introduce QDMTT. So along with the World Bank and the OECD, Jamaica it will be introducing a QDMTT. We'll be meeting, in fact, in 2 weeks' time in Jamaica to look at the impact revenue assessment. We were concerned that because we are in a region where there is a treaty, which is the CARICOM DTA, which is mainly a source jurisdiction allocation of taxing rights treaty, it does have some profit shifting and base erosionary effects. And countries in the region, and of which there are very few, which have corporate income tax regimes are most impacted by that, particularly by way of treaty shopping. some of the countries in the region have indicated that they will be introducing QDMTTs, and so we have to move very speedily, because a lot of our companies, and we recently found out that we had, well, much to our joy, we recently found out that we have over 80 odd companies that are at the threshold of over 750 million. And, but many of them are headquartered in other countries in the region. And so therefore, we have to look very carefully at and move in a very expeditious way in introducing the QDMTT. But we also recognize that the QDMTT itself has to be coherent with the rest of our corporate tax system. And so what we are looking at is a broader revision of our corporate income tax regime. We're also looking at introducing a corporate migration law, and we're also looking at strengthening our anti-avoidance provision. And we hope that together those laws will be able to benefit not only in terms of protecting our tax base, but also in terms of raising revenue. The other benefit that we see from the introduction of the 15% minimum tax is that it does present a kind of buffer for the government, in that, as you would imagine, Jamaica, as a small country, seeking foreign direct investments, that's always a challenge. And sometimes the government is put under pressure, or they feel obliged to give income tax incentives, either no tax or preferential tax regime. We feel that that having that 15% in place in law, then that becomes the a protection, a buffer. It becomes the floor. So you cannot have less than 15%. Okay, and so and we are already having discussions with potential investors, with persons who we were in discussions with before the two-pillar solution for years, and we have already indicated to them that any kind of investment, that times have now changed, and that Jamaica has to honor its international obligation. We have to protect the tax base, and therefore it has to be a blend of investment, but at the same time, revenue enhancing. And so far, we have to say that at least their representatives, which are the accounting firms, have indicated that they fully understand. We will see how that progresses when the rubber hits the road. But what we have been doing as well is a lot of stakeholder engagement to let them know that the government will be implementing the QDMTT, and so that they can understand the changing environment. And in relation to the subject to tax rule, developing countries also view the STTR as an important instrument in enhancing the DRM in their countries, as they are largely source countries. And the STTR helps to protect the taxing rights of source countries. Developing countries were successful in negotiating the STTR to be broad in scope and to include all intergroup service payments. And this is a critical element of the STTR in enhancing domestic resource mobilization in smaller developing countries, and a very significant developing country, I shouldn't say tool, but certainly it really strengthens the developing countries' position in negotiations. for us, the STTR will not help us with the CARICOM treaty, which is where we have most of our issues, because the rates there, all source rates except for dividends, are already 15%. But we do have a very small number of treaties where the STTR will be helpful. So those are my comments and reflections by the developing countries on where we are at this moment. Thank you.
Thank you very much, Marlene. So our last speaker today in this session is Paul Oosterhuis.
Thank you, Niels. Niels asked me to come here today to tell you what's going to happen with respect to Pillar 1 and Pillar 2 in the United States, and the answer is I can't do that. But I can give you some considerations. As most of you know, our political system is pretty complex and confounding. And as a result, it's very hard to predict until we know the outcome of the elections what legislation we might have. First of all, Pillar 2 obviously for us has to be done by legislation as it is by every other country. Pillar 1, while it's as a multilateral convention, in many countries can be signed and implemented as law. That is unlikely that may not be possible in the United States, and even if it were, it's unlikely because of our politics of treaties and conventions being dealt with just by our Senate and with a 2/3 majority, whereas legislation is obviously both houses, and in the Senate sometimes 60 votes, 60%, instead of just a simple majority. And so the politics of it's going to require that there be a legislative aspect of it in the United States if Pillar 1 were to move forward, not just a treaty aspect, even if it were theoretically possible for it to be done just by treaty. So what we need to focus on is what's the potential for, to my mind, legislation in the United States. And that depends first on our elections. You know, I sometimes talk to folks about we're like a slot machine in the United States, and we have two rows in it, or three rows, two options, an R and a D for Republican and Democrat. And if you end up pulling the slot and you get 3 R's, you're going to have tax legislation. If you pull the slot and you get 3 D's, you're going to have tax legislation. If you pull the slot and you get a mix, you're going to have a situation where the most likely outcome is to delay. And that will be because one party thinks they'd rather wait until another election, which will be 2026, to see if they can get the 3 R's or the 3 D's. I mean, the congressional elections will occur in 26, and so they would be a motive to delay rather than to resolve issues. Now, that could be wrong, but that's a fairly likely scenario. So let's talk about what might happen if there is legislation. We get 3 R's or 3 D's, or for some surprising reason there ends up being some sort of compromise. I think that requires us looking at what are the touch points in the U.S. or the sensitive points in the U.S. for each of the 2 pillars. For Pillar 2, the first touch point that is now kind of a hot topic in the United States is the QDMTT. I mean, we have what we call a CAMT, a corporate alternative minimum tax. It's based on book income, 15% rate. So we're pretty close. The problem is that we allow our credits against it, and in particular our R&D tax credit. And so it's become kind of a hot button in the United States for the fact that our R&D credit doesn't qualify as a credit under the QDMT rules in Pillar 2, and that's got to be resolved. Now, that could be resolved by our deciding to make the credit refundable, If we just did that, it would be quite expensive, so probably out of task. We could cut it back in terms of its refundability for example, the Biden administration floated a proposal to make it refundable in an amount to the extent of a certain percentage of the wages that you have in the United States. That wasn't so costly. So that could be a possible way that we could try to make our R&D credit less of a problem from a Pillar 2 perspective. But to my mind, particularly if there's a 3Ds, if you will, there's likely to be a solution to that. And I think we can get over the QDMTT problem in the United States. The question then becomes, what about our guilty as an IIR? And back in 2021-22, OECD staff was quite clear that if we did our guilty provision on a per country basis rather than today it's an overall calculation, and did it at a 15% rate, that we would then be Pillar 2 compliant. The interesting thing about that, this is a hot button issue, is first of all, most multinationals don't really think it's going to raise that much money, and I think they're right, because other countries are going to have QDMTTs by the time this would go into effect, because it presumably wouldn't go into effect till 2026. And so it wouldn't raise that much money at a 15% rate. Ironically, the main way it would raise money is the timing differences, because if we do adapt guilty to a per country limit at a 15% rate, we're not going to change the US tax accounting rules on how you measure guilty income. And that's different than the financial statement measurements that are in Pillar 2, and also the taxes that you treat as satisfying QDMTTs in the foreign countries are book taxes, including deferred taxes, whereas ours are cash taxes. And so there's going to be some timing mismatches, and our legislation would need to have some flexibility built into it to try to accommodate those timing mismatches over time, but that could be done. But the real problem is per country limit has become somewhat theological, if you will, in the United States within some segments of the business community. It's, you know, there's something theologically wrong with a per country limit versus an overall limit. And it's not clear to me that, that if we have a 3R type legislation that the business community and the members of Congress are going to overcome that. But the reality is there's not going to be that much revenue that's raised by going to per country. And so maybe that will, if there's a desire in a Republican administration to be Pillar 2 compliant, then maybe that would happen. The biggest complaint, and this transcends both parties with Pillar 2 in the United States, is the potential imposition of UTPRs on our multinationals once you get through the transition that Marlene mentioned. Because there are a fair number of companies that have a combination of R&D credits and our reduced rates on export transactions, exports of IP and goods and services under the FDII regime. That means a fair number of companies have a rate that's lower than 15% as measured under the QDMTT rules. And so that's a difficulty. So for Pillar 1, I think Pillar 1 compliance is likely if we have 3Ds. It's somewhat less likely, but not out of the question if we have 3Rs. We'll talk a little bit about what happens if we have divided government. On the Pillar 1 side, it's actually less clear as to what would happen. I mean, we don't like unilateral measures, that's clear, so the DSTs are a real problem for the United States, and we have our trade investigations that started in the Trump administration but are still potentially They've been held in abeyance while Pillar 1 was being negotiated, but they could still come back under either a Republican or a Democratic administration if something isn't worked out to delay or eliminate DSTs on Pillar 1. The interesting thing about Pillar 1 is that we in the United States really care about inbound base erosion. That's why we have the BEAT. Most of you who have to deal with U.S. taxes are familiar with BEAT, which was a misfire that Congress adopted back in 2017 to try to deal with inbound base erosion. It doesn't work very well. It hits people it shouldn't hit. It doesn't hit situations that maybe it should. The Biden administration has proposed a couple of different versions of changes to it. And if we do have legislation in 2025, it's likely that it will be fundamentally changed. Now, there's a way that you could adopt a Pillar 1 framework and have an inbound base erosion provision kind of on top of that. And that's a possible thing that could be considered in either a Republican or a Democratic administration, because in a Republican administration, inbound base erosion is still a topic of interest. The kind of America First philosophy and of trying to concentrate manufacturing jobs in the United States, that's a theme of the former Trump administration and potential Trump administration, could lead to some concerns on inbound base erosion that could tie in. There's a tension there, though, with Amount B for our multinationals, because our multinationals obviously are, particularly the ones that aren't involved in DSTs, really care about Amount B being defined and giving them some certainty and giving their distributors around the world a way to minimize international tax disputes. But the way that works out, it doesn't mean much inbound revenue for the United States, because most companies coming into the United States have margins in the United States that exceed Amount B and indeed exceed the marketing and distribution safe harbor. So in order to make these things work, we may need to have an inbound base erosion provision that is outside of Pillar 1 and applies in addition to Pillar 1. So it's possible that whether we have a Democratic or Republican administration, if all three houses are the same party, we could do something about Pillar 1. I think that's less likely than Pillar 2, but it's certainly I wouldn't rule it out. It's funny, I gave a talk at NYU last fall when I said I was tempted to say Pillar 1 was dead, but I'm glad I didn't, because I don't think it may be on life support in the United States, but it's not dead. Now, what happens if we have divided government? The most likely outcome, as I said, is that they will punt on a big tax bill next year because they won't be able to come to an agreement, and instead they'll bet on a better realignment from their party perspective in 2026. That could be a potentially dangerous situation from two perspectives. One is from a Pillar 1 perspective. The United States in that situation is going to want to keep negotiating, right? They're going to want to keep negotiating on Pillar 1 to delay DSTs, and they're going to want to keep negotiating, or however they can describe it, on Pillar 2 to push back the start of UTPRs, right? Because both of those, if they go into place, would be very hard for the United States to countenance. And so if DSTs, granted, DSTs are being collected now in certain countries, but they promise to give back the revenues, right, against Pillar 1 revenues, so we've held off on our trade. But if the process falls apart and the DSTs go into place without any kind of offset mechanism, then whichever administration it is, they're going to have to think about revitalizing our 301 disputes, and that could be a really harmful thing. On the Pillar 2 side, if we don't have legislation and then, say, in 2026 or 2027, UTPRs start hitting, that's really going to be a difficult thing for the U.S. to deal with. And even though we can have, even though in that scenario we don't have a big bill that gets through Congress, there's no doubt that targeted provisions that may actually make life harder for countries that impose UTPRs could be adopted by Congress. So I do worry that our politics may make it hard for us. We may well have divided government. Our politics may make it hard for us to come together in that context and adopt legislation that moves us more in the mainstream on Pillar 1 and Pillar 2. But there are so many forces that are beyond the control of these two particular efforts that may overwhelm the process. So unfortunately, I'm not optimistic about it at this point.
Thank you very much. So these were fascinating perspectives from different stakeholders and also different continents. That's great. I wonder if we, before proceeding to questions from the floor, if we should do just one round where kind of each of the panelists have like just 2 minutes to react to some of the things that they heard from the other panelists. Do you want to start, Manal?
Sure. I mean, I think it is great to hear kind of the deeper perspectives on each of the moving parts. I think it demonstrates the complexity of what's going on. It also demonstrates the importance of achieving outcomes in many cases and the reliance on those outcomes. I do think the U.S. environment is complicated, Paul, and I think that I think you point out, and often you don't hear that in some of that there are ways to get an adopted Pillar 1 deal across the line that involve legislation and conventions, and it's not simply a story of, okay, but there's no way they're going to get 2/3 of the, and we've talked, I think, about the different approaches. I'm more optimistic that this is possible. I think the notion of delaying or keeping on negotiating is not necessary. I guess I don't agree that that is a useful approach. I think that there are other ways to, I think, get to the finish line. So we're eager to get the work done because the reliance on outcomes is critical, as you said, Marlene, that, you know, certainly from a developing country perspective, who've been actively negotiating this, and there are a lot of upsides. It is important to finish the deal and then deal with the implementation aspects, including the parliamentary processes of all countries, right? It's not just the U.S. that has a complicated election and parliamentary process that is going to then shape the next phase of this. So I actually think the value is to finish the negotiations and then address the pieces and the various moving pieces on the parliamentary side as we go into this next phase.
If we can take up a theme that Marlene touched on, and that's incentives, the role of incentives in relation to developing countries and how that actually works. I just do note that Singapore's put forward legislation very recently which sets off its refundable credit against IIR and QDMTT taxes, which is really interesting as a development. But it'll be quite critical for many developing countries to see how they can preserve their incentives in a way that does work for them. I found your comments really interesting in that space.
Well, I just told Paul that his presentation was very good, but I wasn't very excited to hear about ongoing deliberations on Amount A. However, I think One of the concerns that I know that perhaps we all have, but particularly developing countries, is that not every developing country is sold on Pillar 2. Some of them had started looking at DSTs. Some are looking at significant economic presence and so on. And so the danger really to having a multilateral convention, I think, and uncertainty is that countries will become impatient and will start looking at DSTs. So I'm really hoping that we will be able to close on the minor issues that separate us within the inclusive framework, and we will be able to move ahead with that, because then it becomes a bit chaotic. So, and the certainty that the companies want will just not be there. So, and as I said, Amount A is, developing countries don't expect a lot from Amount A, right? But we do understand the importance of having some certainty in the global tax market. The other comment that I will make relates to the implementation of Pillar 2. So whereas we are generally satisfied with Pillar 2 and are actively looking at implementing Pillar 2, we do recognize, and I agree with your Grant, there will be a cost of implementation. And for developing countries, it takes the same amount of effort and work and cost as it does for developing countries and developed countries alike. And so we have to look at not just implementing legislation and so on, but you have to look at the whole cost of implementation in total. And so we do believe that it is important for countries to include in their overall assessment just that cost of implementation is it's important to have the full picture. And then finally, I will just speak about the opportunity that this presents, I think, for developing countries to look at their whole incentive regime. I think that this presents a very good opportunity to look at your incentive regime and also to have it more structured, more balanced, and just to ensure that you're not just giving away revenue, but to have revenues that will actually contribute to the growth and development of your country.
Can I just ask Manal a question here? I don't mean to put you on the spot at all, but obviously we're not going to have legislation in this year. So if there's a signing on Pillar 1 at some point this year when we don't know how the U.S. is coming out, and given that, under the point system, the U.S. has to sign on in order for it to be implemented, is the thought that it's okay to go ahead and start the parliamentary processes in other countries, even though it won't actually be effective unless and until the United States signs on? Is that kind of the process?
I mean, I think the idea is this has been an architecture that has been negotiated over a long time and has now gotten to the point where the gaps are pretty much closed or closing over particularly as we continue that architecture and the discussion, what I refer to as the parlor game of will the U.S. ratify or will the U.S. not ratify, is something that needs to be given a chance to unfold, but the ability to assess that is more likely when you have the finished item out there. So it's clear that, I think it's important to recognize the body of work that's been done, the agreement that's been reached, and have it on the table, and then countries will then go through the processes that they need to go through in order to ratify. And what you're referring to is unique to this particular instrument because the companies in scope, more than 50% are US companies. And so just as a matter of the way that you need the ability to have US participation because of the sharing of the revenue, the reallocation of revenue that is otherwise maybe within the US net. So I think it's really valuable to have it out there. I think the what you laid out as the potential permutations of US political outcomes, in general, I agree. I think the only other thing to mention is we know that there are a number of expiring provisions in the current tax code that may bring bipartisan incentive to actually put in a tax bill that could ultimately lead to adoption. But I think that until the whole package is out there, it is difficult to fully assess and I think there's a value to getting it out.
And it is true, there are some even more important to the U.S. Congress expiring tax provisions. So my concern is that they would deal with them by delaying their expiration for a year as they try to figure out when they're going to get a better hand in dealing with more permanent legislation.
Yeah, but and then just to say, if we don't finish the work, it won't be ready to the extent whenever the political stars align in the U.S. and they're ready to go, there won't be a body of work to deal with. So we've got to finish the work, and I think, Marlene, your point is excellent. I think the patience is running out, so the notion of a continued lengthy negotiation is not something I think is a practical or feasible outcome reasonably for a number of countries around the table.
All right, thanks very much. Let's open up for questions from the floor, and if I can just ask you to wait until someone arrives with a microphone so the whole room can hear you, and also maybe start by saying who you are. That would be great. So there's a question over here.
Hi, Alice Jeffries from the CBI. A question for Paul to begin with, I think, which is the UK obviously is quietly collecting our DST while that agreement's still in place, and also has a plan at the moment to introduce UTPR from the 1st of January next year. Do you think there's going to be pressure for countries like the UK to push out their deadlines for UTPR and DST as well? And then a sort of follow-up from Manal, which is to say, once all these negotiations are done, how long of a breathing space do you think you're going to get before people start looking at the revenue figures to say whether this has worked or not? Because I appreciate all of the points from members of the panel about revenue not being the primary objective, but I think externally the political pressure is going to be looking at those numbers very, very closely.
Well, yeah. There is no hotter touch point in the United States on all of Pillar 1 and Pillar 2 than the imposition of UTPR on U.S. parent companies, because that is seen in Congress as just, somebody else penalizing U.S. companies because they're taking advantages of incentives that in our system we have a harder time making refundable than maybe some other countries have. And that may be rational, it may be irrational. Let's face it, the Trump administration was an important part of the original agreement in Pillar 2 to draw the line between refundable credits and non-refundable credits. My own view now, it wasn't back then, is that the line should have been drawn between expenditure-based credits, refundable or not refundable, and credits that are based on income or revenue or some other metric that expands as companies get bigger. But that's done, and presumably is not going to be revisited in Pillar 2. So we have a real problem in the United States because the R&D credit is like, baseball, apple pie, and the American flag. And a foreign country imposing tax on a U.S. multinational because they were rewarded for their U.S. R&D by having an R&D credit is going to be a very difficult problem.
And then to answer the second part of your question relating to assessing impact, and I do think, I think, human nature is we tend to gravitate to what's easy to measure and assume, make assumptions on that basis, and where things are harder to measure, we don't do as good a job. I think going back to the value proposition of both, frankly, both Pillar 2 and Pillar 1, they are, Pillar 2 is resulting in behavioral shifts, and if you were to just measure it by the gap in collection as between the 15% and where tax is being collected today, even in very high tax jurisdictions, which is an important point. I think this has been made a few times. 53% of the revenue is in a jurisdiction with a statutorily high rate. The real value, and Marlene, you touched upon it, is that pressure on incentives that are very broad-based, that may not be providing economic return and development focus for countries. That pressure is significant, and we hear it over and over and over again from developing countries. The value of being able to have more directed approaches to provide, to development and expenditures that actually return value to a country is really the value proposition, as well as not chasing, what would be distortive activities, and so that tax is not being collected where economic activity is taking place. That is a slightly harder thing to measure, but the net impact is significant, and it's why countries are continuing to value and look at it. And the opportunity is, as you said, Marlene, to review incentives and have more economically viable ones in and of itself has value that is a little less tangible, but I think there is measurement that's going on. The IMF is doing really good work, and we're thinking about that. So I think part of the challenge will be to make sure we get that story, the value proposition, more crisply and data evidence-based and defined, so that we can go. And then similarly on Pillar 1, again, the value proposition there on the first instance is, you can count how many decades where there hasn't been a sort of a collective coming together and a decision that we need to do something to have the coordinated agreement on the allocation of taxing rights recognize that the market needs a greater share. That will be a critical step that will have, if agreement goes forward, will have implications down the road, and we'll look back. And again, the value of that is not in the 100 companies in scope at the moment. It's not in the measure of the amount allocated, or if you actually look at, how much revenue is being generated from that reallocation. As you said, Marlene, I don't know that there's any one country you can point to that's getting a ton of additional revenue from it, but the value is, again, the certainty, the stability, and the sort of foundational focus that in the market there needs to be a pickup. In many cases, those market jurisdictions, including developing countries, while they may not be picking a lot, they're picking up something they're not getting today, and without significant complexity, because it's being done, the filing, there's no revenue being given up because they're not relieving jurisdictions, they're getting some, and because it's market-based, countries that are on the growth side of the market, so emerging markets where there's going to grow over time, the value proposition, the value will be greater in terms of actual revenue collected, but the certainty aspects and the creation, even within the Amount A architecture, in addition to B, of practices of dispute resolution and coordination that are certain and time framed, so that both businesses and governments don't have to expend, tons and tons of resources in disputes. That also will have value that I think in the end will have long-lasting effects and have spillover effects in other areas. So it's a tough one. It would be very easy if I could come up with a calculation and put a number on the table for everyone and say, isn't this? But I think that the system is complex, and I think all business and government understand the hidden costs associated with the tax system that don't always show up in the straightforward calculations, and I think we need to all be thinking about it in that way.
Thanks very much. Who wants to ask the next question? There's one right here.
Hi, thank you. I'm Bryn Rajatharai from A&O Sherman. I've got a question probably for Marlene. So, given you talked about sort of the patience running out on negotiations on Pillar 1, say we get to a situation where we've got an MLC ready for signing and the US isn't signing and maybe other countries are or they aren't, how long do you think we have until chaos? Are we talking months? Are we talking years?
Could you just, how long do we have until?
In terms of countries starting, as you said, to start
Starting
introducing
to-
digital taxes of their own DSTs and back to square one again, effectively. Do you think patience is going to be a few months, or do we have years? I don't know. Just interested in your thoughts.
Well, I think it's difficult to estimate how long it will be before countries start to react if it is that we don't have the US signing the MLC. I mean, let us be very practical. As Manal said, 50% of the companies in scope for Amount A are US companies. And so it will be, and you're talking about reallocation, right, of revenues to market jurisdictions. And so I think it will be very challenging for Amount A to survive. Was it you, Paul, or Grant, who spoke about life support? It will be very difficult, I think. And so what the result of that, if we don't have the US companies, is I do foresee that countries will go ahead and will either, some of them already have DSTs that they have agreed to put on hold. I believe that they will re-energize those efforts, and other countries will also follow suit. I think you will have a variety of digital services taxes, not just DSTs, but I think India has what they call an what is the name of it now? Equalization levy. There are some countries that are still wedded from the days gone by, and I'm old enough to remember significant economic presence, a couple of years ago, being the nexus. And so there are countries that are looking at that as well. So I wouldn't be able to say a time, because it's going to vary, because in all of this, right, you have the political economy. And even with Pillar 2 being appealing to developing countries generally, we still have to sell it to our politicians, right, that this is economically viable. And so I think ultimately it will come down to the political decisions that are going to be made, in what countries believe is in their best interest.
Thanks.
Could I add to that Canada's important? So Canada didn't sign up to the July agreement in relation to withholding DSTs. And it's got legislation that I think has passed the Parliament and doesn't have royal assent, and doesn't kick into place, or hasn't kicked into place yet, in relation to implementing its own DST. It will have a reaction from the US, and I'd be interested in Paul's view as to whether that's bipartisan reaction, as to whether the Democrats and the Republicans don't like DSTs in equal amount, and therefore the US is likely to react to that. So Canada will fall them a precedent. And Kenya, who just recently in their budget said, okay, well, we're not going to have a DST, we're going to have a significant economic presence, and we think that's fine in terms of Amount A, that may well form a precedent as well.
I just want to make a last point, which I have now forgotten. Yes.
If it comes back to you, please let us know. There's another question here.
Good morning. My name is Shweta, and I'm an LLM International Tax student at Queen Mary, University of London. My question is probably to Manal. I just wanted your take on the dispute resolution mechanism in the context of Pillar 2, because you're expecting around 60% of the IF members to have Pillar 2 and its associated rules in place. But we do not have anything concrete at the moment. I understand that the public consultation document had suggested a few measures, and most of the stakeholders responded that they would like an MLI, but I think that would take some time. And many of them suggested a domestic provision in the interim. But do you think that is feasible, especially in the context of developing countries as well, where the parliaments do take time to amend the laws and things like that?
Yeah, let me just clarify. The 60% statistic I mentioned was that we expect 60% of in-scope multinationals to be covered based on the current commitments for adoption in 2024. So not 60% of jurisdictions, but the point on dispute resolution, I mean, I think we have seen the comments, and we are looking at using an MLI structure to incorporate, to formalize and allow or enable and facilitate dispute resolution. But I think the starting point is the embedded ordering rules associated with the system. I think the expectation is, and the hope is, because there's an ordering rule that gives a priority to the QD-MTT, then IIR, and then you get to the UTPR as a backstop, that the hope is we don't see significant clashes where a country is trying to impose on the same company, say, both a QD-MTT and an IIR. But anticipating the potential for that is what we're exploring, is to come up with a dispute resolution mechanism where we think that there could be potential issues. And I think that the phased-in implementation in those first years, because UTPR is still, I think where the concern is often with the UTPR applying is still a ways off. We hope that we'll be able to work through that alongside countries beginning to implement their legislation.
Yeah, thank you very much. Alexander Ivanovsky, CFE Tax Advisors Europe. Well, thank you for the interesting panel. One intervention regarding Europe, and we did mention developing countries, and I appreciate the comment about prioritizing certainty over revenue in terms of what amount B will bring. But I wonder if this is right. It was mentioned that DSTs will bring revenue. I appreciate Manal's comments about human mind thinking of simplicity, and I think that's right. Advisors have been thinking about simplicity, and it's one good goal and a project turning incredibly complex. So going back to my point about Europe, there is a lot of discussion about what the EU will do. We had European elections. There will be a change of the Commission. We had Europe veering off far right. I think there is a really complex political context also in Europe, not only in the US. I appreciate US being relevant for the fact that the current design of Pillar 1 will work if US will ratify it as a headquarter jurisdiction. But EU has in its own proposals on the digital services taxes and effectively Pillar 1 calculated that to be part of the next EU budget. So at the moment, taxation in Europe is seen as war taxation. Europe is sort of a continent of war at the moment. Do you think this is really something that's right to continue, or maybe actually going back a couple of steps and saying, right, maybe DSTs or a European DST with appropriate relief mechanism would actually work better? Thank you.
Well, I think that is a calculus that government policymakers need to reflect on, and I think have reflected on and have remained at the table, because the consequences, it's not as simple as you sort of sit in your, this is why, I go back to, there's a international cooperation exists because there is a calculus that if we go it alone, that the long-term impact of that the ability to succeed in achieving our domestic objectives, and whether that's raising revenue or doing other things, will actually not be realizable in the long term if we go it alone. And so that cooperation and a coordinated action is better. And that calculus is the one that is the complex one that I was referencing, because there are consequences to each of these moves that then have costs, that there's reaction, there's counter reaction, and there's the stability costs and the reliability costs. So I think to date, those that are at the table, and even those who have DSTs today, have continued to come out that the calculus of having a coordinated approach that's stable is, in the long run, more beneficial and will generate. And it's not about trade-off of revenue versus stability, because in the end, stability has a direct impact on revenue. So it's just a matter of how I'm measuring the value that is gained. And I think to date that value proposition has suggested that it's worth staying at the table, and that coordinated outcomes are, in the long run, the ones that are going to preserve the potential for revenue the most, and will lead to more stable. And I'll just say also, the risk here is not just about, I mean, I think we talk about it in terms of DSTs or other, but I view the risk of the absence of a coordinated action here to not just be our country's going to adopt a DST or another similar measure. It's that in each of these unilateral decisions that begin to push up against existing agreements that many take for granted and have lent stability, and whether those are tax treaties or approaches to transfer pricing, the more that there are unilateral measures, and each of them taxing in ways that we haven't seen before, and push up against and sort of challenge these agreements, the agreements become less reliable, and it's a bit like, you pull the yarn from a sweater and it starts unraveling. And that is the concern. I think that's what's keeping a lot of countries at the table. A system where one country does something, another one reacts with a tariff, and then the question is, that is not a particularly attractive outcome for many policymakers. So I think that is the way that it's being addressed. But you're right, it's a calculus that every country needs to evaluate, and the calculus right now has everybody at the table.
And if I could add one thing, if DSTs become more prominent, meaning more countries do it, meaning rates go up, first of all, the United States is not going to be giving credits for them. I realize the Indian equalization levy now may be eligible for a foreign tax credit in the United States under our rules, but over time, they're not going to be credible in the United States, which means, and they really do operate more like an excise tax or a tariff than an income tax. They're a tax on revenues. And so I would expect economists would say that they're likely to be passed on to consumers more than borne by the owners. In talking to the U.S. companies who are already dealing with DSTs, some of it is being passed on directly or indirectly, and over time that will grow. Ironically, one of the reasons why they may not be passed on as much as otherwise is because right now they're kind of sporadic, and you set your pricing up not just country by country, but kind of line of business by line of business, and so it's kind of hard to do the refinements. But if they become more generalized, some of the companies would say, yeah, we'll build that into our pricing structure. So be careful what you're doing when you're adopting DSTs, because over the long run, they may largely be coming out of the pockets of your consumers or other users, not necessarily out of the giant companies, and certainly not out of the U.S. Treasury in the long run.
So my memory has come back. And it really had to do, actually, with that discussion about multilateral DST. Because the longer the amount Pillar 1 has drawn out, is a more people start looking at, well, what else could this be? Because I think that there is a sense that we want a multilateral solution to this issue, right, of digitalization and globalization. But, you know, as I said, other things are emerging now as I guess, Plan 2, right? Or Plan B. And it's one of the things that has been discussed. Well, shouldn't we just have done multilateral DST and be done at a low percentage rate and just be done with the whole thing? But, you know, as Manal said, that may not have been, and I think it had been rejected. It was briefly discussed, and it had been rejected at the inclusive framework. I just wanted to make the point as well. I think you said something about revenue over certainty in terms of Pillar 2. No, and the point I was making is that it's the opposite, it's the other way. We believe, developing countries believe, that we will not benefit much from Pillar 1. I mean, we're very happy about Amount B and the simplification of the transfer pricing rules. So from an operational standpoint and possibly a revenue standpoint, we're happy with Amount B, but you know, there can be no Amount B without Amount A, right? But Pillar 2 is where we are hoping to maximize on our revenue, Pillar 2, because at the moment, the incentives that most countries have, developing countries, are wasteful incentives in a lot of cases. And so having that 15%, right, will structure your ability to tax these multinational enterprises, which you are not able to do now. And so the revenue that you may collect from that may not be a lot initially. But when you compare it to the fact that a lot of the incentives are wasteful and you're not recognizing the benefit of them in any event, then we consider that at least if you have the minimum tax or QDMTT, then at least you're able to get in some revenue that you're not getting now at the moment.
All right, so we are rapidly approaching the coffee break. I just want to abuse my role as a moderator a little bit here at the end to ask my own question, and I guess it's for you, Manal. So I'm an academic economist, and from my perspective, kind of one of the great benefits of all these policy developments is that they're producing data. All right, we kind of new data that allow us to understand better how multinationals are structured, and also ideally allow us to kind of to track what is working and what is not working in terms of these new policies. And so I guess one example of that is the CBCR, where kind of both national tax authorities have allowed researchers to come in and actually work with firm level tax, CBCR reports and learn from that. And OECD has been brave enough to actually also kind of put aggregate statistics on the website that we can all kind of go and see how many profits are reported in Luxembourg and how much, what is the tax paid on these profits and so on and so on. So I think that's been great. I wonder if we can push that forward, extend that to other domains. So so one question I guess is when the globe tax returns start coming in, will you also put aggregates online that we can see how globe is playing out in the aggregate, not firm level data, but in the aggregate. And one thing that I've been wondering for a while is the common reporting standard. Now you talked about the global forum for a while. So it would be fascinating to see kind of a matrix like the one you have for the CBCR saying how much wealth is managed in Switzerland and who are the ultimate owners by country. So you could do that, right, based on existing data, and it would have the exact same role of kind of allowing the public to track how is the progress going in terms of getting the behavioral responses that you want from these policies.
Yeah. So I guess with respect to your general point, I think in terms of one of the things we do at the OECD and we really value is the ability to be a convener of data that can lend itself to analysis, and very importantly, we think it is important not just to do impact assessments on the front end of a new policy or a new standard, but to constantly reflect on is it having the impact that it should, and we rely heavily on data, and where we can share that data and then also get the benefit of others doing analysis and lending to the conversation and hopefully informing the continuation of good policy outcomes. So in general, very, very supportive of that. I think that, we'll look to see as new things evolve where we can do that while also respecting the understanding that allows us to be effective of what countries expect of us in terms of sharing their information. With respect to CRS and the ability to have had that, again, the transformational shift that ended bank secrecy or makes it quite difficult in exchanging information. There are standards there that are quite important relating to the role of the OECD in doing that and the importance of confidentiality of information. And so, again, not in our role would we be able to do something that wouldn't be acceptable to the countries who provide the information. But I would say that I just can't emphasize enough, we value the ability to use data to constantly reflect on is something having an impact, suggesting where we need to pivot and to be able to inform future policy making either at the domestic level or the international level, but we also then need to respect the processes that are in place.
Thank you very much. That's going to be the last words of this session, so I'm not going to hold up coffee anymore. Coffee is in the lobby, and we'll convene here again at 12 o'clock for the next session.